Chapter 2, further look at financial statements. Let's see. Okay, the study objectives here. Identify what makes up the classified balance sheet. We're going to produce or compute ratios for analyzing a company's profitability. We're going to explain the relationship between retained earnings statement and the statement of stockholders' equity. Then we're going to identify and compute ratios for analyzing liquidity and solvency of a company using just the balance sheet. Then we're going to look at the cash flow statements to evaluate solvency, and then we're going to discuss many financial accounting concepts. To begin with, a classified balance sheet. This reports, or this is a snapshot at one point in time. As at December 31st, this is my balance sheet. The next day, the balance sheet will change, but right at the close of business, December 31st, this is my balance sheet. And what we have, we call it classified. We put all the assets into categories, and each category we classify it, we give it a name. So the classifications here are current assets, long-term investments, property, plant, and equipment, and intangible assets. Liability is shareholders' equity or stockholders' equity. We classify those into current liabilities, long-term liabilities, and shareholders' equity. So these we're going to look at a little more closely. Begin with the classified balance sheet. You see, we've taken all the assets here and we classified them as to which ones are current, and we'll give them a definition. A current asset is one that's going to be used up in the next month. Here we're looking at Franklin Corporation balance sheet as at October 31st. That's close of business October 31st. These are our assets, our current assets, our long-term investments, our property, plant, and equipment, and our intangible assets. These are our liabilities, current liabilities. Now, liability is what we owe. We'll talk more about that later. There are current ones, that's liabilities we're going to have to pay in the short term. Notes payable, accounts payable, salary and wages, interest payable, that kind of thing. Longer term liabilities, if I have a mortgage on a building or a bank loan or notes payable, they're classified as long-term liabilities. Shareholders' equity, we have two categories, common stock and retained earnings. More about all of these. We're just talking about the different classifications now. You don't have to know all of that in depth, just the general headings. Now, the current assets are expected to be cash or converted to cash within the very near future, no longer than a year. An operating cycle is the average time it takes to purchase inventory, sell it, and collect the cash from the customer. So for current assets, for Southwest Airlines, this is the partial balance sheet. They have cash and cash equivalents, which means term deposits, of $1,390,000,000. Keep this as in millions, as you can see. They have short-term investments, that'd be stocks or bonds, 369. They have accounts receivable. That is money owed to them by customers. They have inventories of 181, prepaid expenses, so the total $2,601,000,000 in current assets. That's Southwest Airlines. Now, when we talk about the next category, long-term investments, these are investments in stocks and bonds. And there are also, those investments are there are investments in long-term assets such as land and building, which are not being currently used in operating activities. You don't see that too often. What you do see is property, plant, and equipment. These are assets that are going to be used by the company for more than 1 year. And they're used all the time in operations. And as they're used up. And when we use something up, we call that depreciation. And that's allocating the cost of the asset over the number of years that we use it. And then we have a new account called accumulated depreciation. And that simply keeps track of how much depreciation has been taken off that asset since the very start. Okay? So here's how it looks on a balance sheet. This is Cooper Rubber and Tire. Again, this is in the thousands. Land, 41,553,000. Buildings, machinery and equipment. All of these are long-term assets. We're going to use them for more than a year. They're not current. And we subtract how much we've used up. So there's the total we paid for all these assets. minus how much we've used up. It gives us the total balance of what is to be used by, what still remains to be used up by these long-term assets. Intangible assets, that's like trademarks, Coca-Cola trademarks, goodwill, franchises, brands, all kinds of things that has no physical substance. That's why they're called intangible. Intangible means no physical substance. Current liabilities, like current assets, liabilities are obligations. These are debts that the company has to pay, and it has to pay within the next year. And these usually list the notes payable first, followed by accounts payable, and so on. To give you an idea, current liabilities, here we have notes payable, 239, accounts payable, 24,242, and so on, total current liabilities. Long-term liabilities, those are debts that will have to be paid, not this year, but over the next 4, 5, 10 years. And they are classified that way. Stockholders' equity, there's two categories. Common stock is what the shareholders paid for the shares that they invested in this company. And retained earnings is the amount of income the company has earned since the day it started and has kept, as not given back to the shareholders. Now, when we use financial statements, we use a technique called ratio analysis. A ratio is simply a relationship of one quantity to another, a numerator and a denominator. A numerator, when you think of a fraction, the numerator is the top and the denominator is the bottom. And we have different kinds of ratios. We have profitability ratios that measures the income and operating success of a company. We have liquidity ratios, which tells us how well a company could meet its short-term debts. And we have solvency ratios that measures their ability of the company to survive over a long period of time. We use the income statement. Now, the income statement for many of these, for profitability ratios, we use what's the income statement. The income statement is simply revenues, two categories, revenues minus expenses. Revenue minus expenses gives me net income or net profit. All right, so here in 2008, we had revenues of this. We had total expenses of 38,616. We had net profit of 1,407. In 2009, we had more revenues, but we had more expenses. We had less profit. So we look at this from profitability ratios, and we compare the profit to the number of shares that the company has in common stock. For example, Best Buy Company, 2008, had net income of $1,407,000. In 2009, they had that. They had no preferred dividends. These are the number of shares. At the beginning of the year, they had 481 shares. They reduced that at the end of the year, it was 411. Next year, the 411 went up to 414. So the earnings per share is the net income minus preferred dividends over the average common shares outstanding. So we take the net income for 2009, take the average number of shares, and we get earnings per share. For every shareholder, they earn $2.43. How is that compared to 2008? Well, you can see it's not as good as 2008. In 2008, the shareholders earned, on average, $3.15 for every share that they held in that company. So using financial statements, we use now the classified balance sheet to do what's called liquidity ratios. We first look at working capital. Working capital is defined as current assets from the balance sheet minus current liabilities. Current assets is the cash or near cash that we have on hand. Current liabilities are the debts that we have to pay within the current year. So our working capital is the amount in excess of the current assets that we have. So for Best Buy, current assets in 2009 over current liabilities means that for every dollar of current liabilities, Best Buy had 97 cents of current assets. Now we can compare that to last year, 2008. We can compare that to another company. We can compare that to the industry average. And you can see that this company, Best Buy, is not doing as well in 2009 as it was in 2008. It's not doing as well as this company, and it's certainly not doing as well as the industry average. Now, we use the classified balance sheet to determine solvency ratios. Now, solvency is the ability to pay your debts when they come due. Now, again, we take a look at this ratio. This is called the debt to total asset ratio. And how it's defined is we take the total liabilities, total debts, over the total assets. So for Best Buy, if you look back at that financial statement, Best Buy's total liabilities was that, their total assets were that. They have 71% of their total assets are owed to people outside the business, are debt. How does that compare? Well, last year it was 65%, so we're getting worse. And it's less than, or it's more than H.H. Gregg, and it's more than the industry average. So Best Buy is not stacking up. Okay, gotta get rid of my friend here. We'll skip this one. In fact, I meant to skip that one. Standard settings. Now, we're going to talk about who sets the standards for accounting rules. We talked about the rules. Generally accepted accounting principles are a set of rules and practices having a substantial authority. These rules are defined basically by the Financial Accounting Standard Boards. Now, there's also the International Accounting Standard Board. Those are the main ones that say, okay, this is how you're going to record accounting transactions and present them on financial statements so that they're done the same way all around the world. Now, financial reports, okay, according to according to FASB, useful information should possess two fundamental qualities: relevance and faithful representation. Relevance is the accounting information that is relevant. That means it makes a difference. Information is considered to provide information that has predictive value, and I can confirm this. Okay. We also have the idea of comparability, consistency, verifiability, understandability, and timeliness. Assumptions in the financial reporting. We'll talk more about this. Everything's going to be on what's called the monetary unit. That is, everything is in terms of dollars, if we're in America, dirhams, if we're in the UAE, but it's flus. That's what everything on the financial statement is represented as flus. The land, the flus I paid for it, the building, the flus I paid for it, and so on. And when we report, we're reporting for a particular period. That is a year, 2008. This is what's happened between 2008 and 2009. Nothing else, not before, not after, just that period. And we are reporting just for that economic entity. Boy, I got a persistent friend there, eh? Anyway, almost finished. Economic states that every economic can be separately identified and accounted for, and states that the life of business can be divided into parts. Assumption that the business is going to continue. It's a going concern. The accrual-based business means that we're going to record transactions in the period in which they happen, not when we receive the cash. We're going to do more about this as we go on. All right, principles. There's the cost principle. We record everything at cost. We have a verifiable record of it. Indicates that assets and liabilities should be reported at fair value, and requires that companies disclose all circumstances and events that would be different to the financial statement. A couple of constraints: materiality, that is, something has to be of value. I mean, we're not going to record every little paperclip we have in the company. It's immaterial. It's not going to make a big difference. And the other thing is the cost constraints. Accounting standards weigh the cost the companies will incur to provide information as to benefits. That's it for that. Shift